Hi, I'm Jonathan J and welcome to Dealmakers.co.uk, the #1 place for business buying information. On this video, I want you to meet John Andrews, my lawyer. He's speaking to a group of my mastermind clients all about the legal aspects of buying a business.
So I'll start off with the differences between assets and share purchases. I've obviously done deals for some of you that are here, asset purchases and share purchases. If I'm pitching it too high or too low a level, do let me know. But fundamentally, the first thing you're going to have to decide once you've sorted out your target is what's the structure of the deal going to be. If you're buying from an individual, an LLP or a sole trader, a partnership, then what you're going to have to do will be an asset purchase. You have no choice over it. If it's a limited company, whether or not you want to do a share or asset purchase will be driven by a number of factors. Firstly, the seller may only be interested in doing a share sale, and the reason for that will be tax driven. They'll want their entrepreneur's relief early and simply, and the best way of getting that is by way of doing a share sale. The second thing that will drive your decision, quite apart from the seller's position, will be the risk in the business. So if you're looking at a business, doing an asset purchase is always going to be less risky from a liability point of view. And the reason for that is that you set up your SPV will buy the business and assets from the seller, whether that's an individual or another company. The contracts will always make it clear that unless you accept clear liability for anything that was done before you buy the business, that there is a clear cut-off point at completion. So when your SPV buys the business and assets, it leaves behind all of the skeletons in the cupboard from the business that you've bought. So that's the real driving factor as a purchaser for doing an asset purchase. The downsides of doing an asset purchase are that they can be more complicated. Jonathan sometimes will disagree with me on this, or we've got different views on this. The reason I say that from a legal perspective is, first of all, there is a change in the entity that is providing the services for the business that you're buying. So if the business you're acquiring is contract driven and there are long-term contracts, there is going to be a change in provider. And what that means is, generally speaking, you will need to get consent quite often from all of the people that the old business is doing business with to the transfer of the contract. And a key part of the due diligence process on an asset purchase is looking out for change of control provisions. So typically, if you've got long-term contracts with big companies, with local authorities, health authorities, they will all invariably have a clause in that says, if there is a change of provider, we have to give our consent to our contract being transferred across. And that's obviously a key element when you're looking at buying a business. Okay? If you do a share purchase, more often than not, there isn't an issue, because the same company, before and after you buy the shares, is providing the service. However, again, local authorities, health authorities, will still often have a clause in their contract, which is a change of control clause, which will say if there is a change in the share ownership of the company that's providing the service, we have the same right to be consulted and to give our consent. And if you don't get our consent, we can terminate the contract. So these change of control provisions are probably the most important thing that we will look at in our due diligence process for you, whether it's a share purchase or an asset purchase. Looking at share purchase, I'm still dealing with the cons of an asset purchase. The other part of it is that in addition to the legal transfer of the business and assets, the property will almost invariably, if there is property involved, have to be transferred across to your new SPV. So if it's a lease, it will be assigned across. If it's a freehold, that freehold needs to be transferred. With a share purchase, provided the building, whether it's leasehold or freehold, is registered in the name of the limited company that you're buying the shares in, you don't have that separate process. And my experience is that quite often we're asked, how quickly can you get this deal done? Share purchases, provided the properties are registered to the limited company, we can work to your time frame, generally speaking. So, if you say we want it done in 2 weeks, it's a month or 2 months, that's fine. With asset purchases, if there's a lease involved, the freehold of that property, so the leaseholder, will want to know all about the business that's going to take the lease over. So they have to give their consent to assignment, and what that means is there can be a delay of 2 or 3 months while the landlord says, I want to find out about you. I want to see your accounts. Who are you? Will you give a personal guarantee? Will you give a rent deposit? None of these issues typically arise if you're buying shares in a company and the property's already in that company, because that's already been dealt with. Turning to a share purchase, the pros of it are, generally speaking, that's what the sellers want to do. Secondly, there is continuity of business. So there's no change in the business that's, or the entity that's providing the services. That then means that you acquire business with a trading history, which is really important, with a credit history quite often. Whereas if you're buying a business and you put it all into an SPV with assets, you're starting afresh. Typically, you'll take over the bank account as well, so you haven't got the aggravation of setting up a bank account and going through the rigmarole that banks now require you to go through. And there's no TUPE issues, so the staff are still employed by the same company before and after you do your deal. So in many ways, it can be more simple. The downsides of it are it's riskier because you are acquiring shares in a business that's got a history. And that's why your due diligence on a share purchase would invariably be more in depth and more expensive, I'm afraid, but more important for you because you need to know what are the skeletons in the cupboard. So have there been staff issues? Have there been claims from clients or issues on contracts? All of which, even if you didn't own the business when these took place, you will be taken on because they will all be under the umbrella of your limited company. So share purchases, to sum it up, share purchases, sometimes simpler, sometimes quicker. They're what the sellers generally want, but they're riskier. Okay? Asset purchases, you de-risk to a great degree the transaction that you're undertaking, but you increase potentially the complexities of the legal process, because you've got to get the staff transferred across, properties transferred across, and potentially contracts. So on each deal, you will need to weigh up, does the risk of doing a share purchase outweigh the benefits that it's got, quite simply. So that's comparing the two types of transactions. So are there any questions on that at all?
Quick question. You said obviously there's that snag point of they want to get the entrepreneur's relief from a share purchase sale.
Yeah.
So I was talking to a business owner and I explained it to him, and he told me that if he was to just shut the company down and retire, he could then get a similar percentage in terms of tax.
Yeah.
So could it be that you could do an asset purchase from that company, the money goes into their company, and then they just shut it down, so they still get the relief and you get the asset purchase?
Yeah, that's exactly right. You can do that, but to get to that stage, he has to do essentially a solvent liquidation of the business, which is another legal step, another legal process that they need to go through, and that can take 3 or 4 or 5 months to do. Right. Plus there's a cost of sort of around 10 grand to do that. So that's why there's a reluctance to do that. More often than not, sellers just want a clean deal where they say, I want my £200,000 and I'm paying tax at 10% on that. That's the deal that I want to do. But you're absolutely right. There is a mechanism to get there in the end. Yeah, and the additional legal cost, yeah. Okay, so looking at the two forms of acquiring a business, the other key thing to think about, and this is maybe a step before, is if you're going to set up an SPV or group structure, typically most of the people that I've acted for are doing a group structure acquisition. So you set up your initial holding company, and that holding company either does share acquisitions directly, so the business you buy becomes a direct subsidiary, Or you set up a subsidiary of the holding company, and that subsidiary acquires the company or the business and assets. Really good way to do it, and the reason you have a group structure is that it enables you to compartmentalise each acquisition that you do. And the reason that's a good thing to do is if any of them don't work out, and you decide actually that's a business I'd like to sell or I'd like to wind up, you can deal with that distinctly without it impacting your group company or the rest of the companies in the group. So that's why group structure is a really sensible way to do these acquisitions. Probably a really important thing to think about is going forwards, and this may not cross your mind initially, is are you going to bring in investors at your group company level? If you are, it's probably sensible at the outset to get your group company or your holding company set up in a proper manner. And what I mean by that is look at the articles that you've got. So if you use off-the-shelf standard articles, there are two problems with that. First of all, if you're the sole director, there's been a case recently that's held that sole director companies that have model company articles, so the standard ones, cannot do anything other than appoint another director. So essentially, if you have model articles, for the company to do anything validly, and this is a really recent decision, there have to be two directors, or you have to change the model articles to say that those articles will allow a sole director to operate without the benefit of a second director. So that's really new. That may well get changed on appeal, but at the moment the law is sole director companies need to change their articles or have two directors. Sorry, did you have a question about that?
He's worked for 50 of my mastermind clients in the last few months alone. His name is John Andrews, and I've got his details right here in my little back book of contacts. You can phone him on 0345 241 2494, or you can email him on johnandrews.deallawyer@jmw.co.uk. If you want someone who can get a deal done, he is your guy. So let's get back to the video.
Hello there. Hi John. Yeah, it's really important, that part of that, because it's just come up in the last acquisition we've just done a few weeks ago. One director and 9 companies on, we've used the same articles, and their side, their lawyer, big Manchester lawyer, they used, read through the articles. He must have a very boring life as far as I'm concerned. And nobody else in 8 previous acquisitions has gone through those articles and pointed this out. But that was brought up, and that nearly scuppered the deadline nearly for the deal. And fortunately, it cost me a bit more money. I think it was about 1,500 quid or something like that to rewrite the articles. Again over a weekend. But I did give my lawyer a bollocking because he'd not done enough work previous to that, but he pulled it out of the bag to get the deal done on the deadline day by working over the weekend. So
good. But it's becoming a real issue now, actually. I mean, the problem is banks are now starting to worry because they've had all their loan agreements signed by sole directors, and technically, legally, they're not enforceable. So, so coming back to the point of it is, having standard articles, if you are intending to bring investors in at some stage into your holding company, are probably not suitable. And it's better to get these articles right when you incorporate the company than change them at a later stage. So the sorts of things you'd want to change in your articles will be, first of all, share classes. So model articles have one class of share. So what that means is if you've got 50 shares and you give 30 shares to somebody else, an investor, you can't declare different dividends because there's only one class of shares. So if you give yourself a dividend calculated by reference to your 50 shares, you have to give a pro rata dividend to the 30% shareholder. If you create different classes of share, and they call them alphabet shares, so A, B, C, D, you can have as many classes as you want. First of all, you can have different rights attaching to those shares. So some shares might have a right to dividends, some might not. Some might have a right to voting, some might not. So those sorts of things you can be really flexible about if you've got different classes of share. Most importantly, you can provide in your articles that you can declare different dividends on those different classes. So irrespective of how many number of shares you've got, you can create different rights to dividend in your articles. And these sorts of things you may never use, but if you've got them already written into your articles, you do bring somebody in the future, you don't have to go back, change the articles, maybe go to your lenders and say, look, we want to change our constitution, is that okay? Because quite often their loan agreements require their consent. All those sorts of things go out the window if you get your company set up right on day one. The other types of things you want to build into your articles will be preemption rights. So again, under the model articles, they don't have extensive preemption rights. So what that means is, if you allot some shares to somebody under the model articles, they've got those shares. They can do what they like with them. They can go off and they can use them as security. They can sell them if they want, and they can sell them to whoever they want. If you have bespoke preemption rights, you can control where those shares go, when they can be sold. So you can basically say, if you want to sell your shares, you have to offer them to me first. If you sell within a certain period of time, you're not going to get full value for them. You might only get par value, so £1 per share for them. So you can control everything about those shares through your articles, and the model articles don't do that. And you can also include what are known as good leaver and bad leaver provisions in the articles. So if the person that's getting shares is also an employee or director in the company that you're acquiring, for example, you can say in the articles, look, these items will make you a bad leaver. So if you resign within 5 years, you're a bad leaver, typical one. If you're convicted of a criminal offence, all sorts of things like that, you can say, in those circumstances, I can force you to sell your shares back to me for a nominal value. The other thing you can do is with these preemption rights is that you can say, if you're long-term sick, for example, we might have a right to acquire your shares back, or to apply a reduced value or a reduced dividend right to them, because as an employee you're not contributing what you should be to the business to build its value. So your articles are a really good tool for you to control what happens to the shareholding in your holding company. And you can filter the articles that you use for your holding company down into your subsidiaries and have similar rights in all of those subsidiary companies. Another thing to bear in mind is that quite often, particularly where you've got your holding company and you've set up an SPV and you're going to do an asset acquisition, or you are going to use your SPV to acquire shares in an existing trading business, you might think at that stage of bringing in part of the management of your target company into the shares, or you might bring some investors into the shares at the SPV level. If you are going to do that, again, make sure the articles are suitable in your SPV, give you the rights that you want. And also, most importantly, you want to do that share allocation, ideally, before you've completed the deal. And the reason for that is this. When you set up an SPV, it owns nothing. It's got the £1 share that you set it up with. The day after you've done its acquisition, unless the deal is fully leveraged, so you've borrowed everything and the business has no value, the day after you've completed, that business has a value. If you then allot shares to directors or employees post-deal, potentially you're creating a real tax issue for the company and for the employees, because essentially you've given them some, they won't want to pay for these shares. You've given them some shares that have got a value, and unless they get good accountancy advice, they will end up with an income tax liability. So if the value of the shares that you've given them is 50 grand, for example, they will end up paying income tax on £50,000. So you need to be planning where you're going to get to and when you're going to allot your shares and what rules are going to apply to those shares. Another important element of articles will be drag-along rights. So you guys are going to be driving these acquisitions. You're building a group, and the idea is you're going to exit at some stage. What you don't want is any minority shareholder to be able to say, well, look, you might want to sell, but I don't think you're getting a great deal, I want to hold on to mine. So drag-along rights in shares give you the ability as the majority shareholder. In fact, you don't even need to be in a majority. If you've diluted your shares down, provided your articles say that a particular percentage can exercise the drag-along rights, you as the controlling shareholder, let's put it that way, can force a sale of all the shares in your group. And provided you are ensuring that everybody is getting the same pro rata sale price for their shares as you are, you can exercise those rights without having to worry about their consent. So you drag them along on the sale. So these are all quite technical points, but they're really important points that people don't think, because on day one, you're buying your off-the-shelf company and you're doing your acquisitions, and it's only afterwards you start to think, well, hold on, our MD's got some shares. What happens if he leaves? Well, if you don't change your articles, he keeps them. What that then means is he gets his share of the dividends. It also means you have a sale, he gets his pro rata proportion of the share price. So you need these rights to claw the shares back, and you do that typically through your articles. You can have a shareholders agreement, but it's far better to have them in the articles because they're enforceable against the company as well as the other shareholders. So that's your group structure. We've gone through the comparing share sales to asset sales. Where do we go? So should we talk about sort of structuring deals? Maybe that's what we should talk about. So obviously, sellers want as much cash up front as possible. And from your perspective, and if you're on this course, you know, A, you want to put as little money as possible. Certainly not any of your own money if you can avoid it. And then you're going to be looking at, in those circumstances, borrowing money from third parties, from institutions typically, and deferred consideration. So essentially you'll fund your deal from two sources if you're not using your own cash. That will be lenders who will want their security for the money they're lending. And it will be the sellers, essentially that they're another lender to you. And when I'm acting on these deals and we've got deferred consideration, the key issues that always come up are A, personal guarantees, and B, security for any deferred consideration. And I get that, because if I'm acting for a seller, that's exactly what I want to have. And there's always a battle as to what your institutional lenders will allow you to do, because if you're borrowing from a lender, they want a first charge, typically a debenture, over the business and assets. So in reality, they have first call on everything if you agree to do that, and most lenders are not going to lend you money unless you give them that security. So a debenture is essentially a legal charge that gets registered against the company at Companies House, and it sits over all the business and assets of the company. And provided you're not in default, it just sits there and you can trade normally. If you default, a debenture allows the bank or the lender to appoint a receiver, take over the business, and actually then collecting the receipts of that business, attempt to realise its assets, all at your cost, because what happens is the receiver gets appointed, he gets paid first, then if there's anything left over, the bank get a bit, and after that, if there's anything, possibly the sellers get it. And sellers are aware of this, but if they want to do a deal, particularly if there's no other exit for them, they're going to have to accept that there is this risk in the process. So what sellers will ask for, if they can't get a first charge, is that they'll ask for a second charge. We try to avoid that, but in reality, if you've already given a debenture to a first lender, the downside of giving a second charge for deferred consideration is not that great. Because if you ever get to the stage where the second charge gets called in, the first charge is going to get called in by default, and they will take precedence. So giving a second charge for deferred consideration is the lesser of two evils. Far better than giving a personal guarantee. You do not want to get involved in that. And I think it's important to make it clear when you are making offers on businesses and you're agreeing your heads of terms, you make it clear in those heads of terms that personal guarantees are not available. And Jonathan's got some really good tactics as to how you explain that. One of which is, I'd love to give you a personal guarantee, but the terms of my borrowing from my main lender mean I've had to give them a PG, and they won't allow me to give a further PG to you. There are some alternatives to a second charge. So If you give a second charge to sellers as a debenture, it's over all the business and assets. You can give a distinct charge just over the shares. So sometimes we do deals where we say, look, we won't give you a debenture over the whole business and assets, but what we will do is we'll give you a charge over the shares that we've acquired or a proportion of the shares that we've acquired. And then if we default, those shares go back. I don't particularly like those deals, and they're not particularly beneficial for anybody, because if it ever gets exercised, the seller ends up taking back all or part of a business that is probably failing anyway if you've not paid them. So, but psychologically, sellers like to know that they're not just trusting you completely to pay them their deferred consideration. But whatever consideration or whatever security they take, if there is a first lender in place already, provided it's not a PG, it's not something, in my view, that should be a deal breaker, because the practicalities of it are, if you ever get to the stage where they're enforced, the first lender's got to come in anyway. Okay? So in terms of deferred consideration, if I'm acting for a seller, I usually say, don't sell your business unless the sum you're getting up front would be sufficient for you to do the deal anyway, because there is always going to be a risk of deferred consideration. If I'm acting for a buyer, we try and get as little as possible, clearly, paid up front. And then the terms on which it's deferred can really vary. So it might just be a simple thing that we're going to pay you X amount over 1, 2, 3, 4 years. So in those circumstances, you fix the price. In other circumstances, you might fix it by reference to turnover. Not really great. Profit, far more sensible. So, and particularly if the sellers are going to stay in the business for any period of time, you're going to buy the business, but you want them to stay, they're going to be driven to get to those profit figures, and actually that's a benefit to you. That's the only benefit really of keeping sellers in the business, is if they're on an earn-out. Other than that, my view is try and get them out as quickly as possible, because you should be buying businesses that are not dependent on the sellers, but that have got a good management team, a good management structure, because that's what you're invested in, really, unless you want to go in and run it on a day-to-day basis. So if we're going to go on that route and we're on a performance basis, you're then going to look at what are the key factors going to be, and over what period of time, and what figures are we going to look at? Are we going to buy this on a multiple of EBITDA, for example? Typically deals are done on that. Or is it a straight fixed price? So those typically are the two main ways in which you calculate deferred consideration. So I'll pause there. Are there any questions about what I've spoken about there at all?
In terms of an earn-out, I was speaking to someone about this, and they were asking kind of what they would be paid whilst they were doing an earn-out. So if their deferred consideration was, for example, 50% of the profits, but they're staying in the bit, are they going to get that 50% of the profits and also an extra salary on top of that for that year that they're working? Does that make sense?
Well, yeah. I mean, typically, if they're going to be working in a business, they would get a salary. But don't forget that salary will come out the profit, the profit figure. Yeah. So, yeah, it'd be pretty unusual for somebody to stay on work in the business and just working for their earn-out. They would typically want some form of salary.
Fine to know who's going to ask you the question here. We've structured an opportunity with the seller where we have agreed to pay a fixed price over 3 years. We've agreed to pay a separate consulting fee that is tied to activity that we dictate. And the third part of the payment is to give him an earn-out. Now, we had considered giving him a percentage provided the EBITDA is 10% greater than the previous year's EBITDA. Then he will get 17.5% of the total EBITDA. Does that make sense?
Yep, absolutely.
Yeah. So if he performs well as a consultant, helps us increase turnover, assuming the expenses remain pretty much the same, then the EBITDA will increase. We will pay him out of EBITDA the fixed portion, and then we give him 17.5% of that EBITDA increase.
Yeah.
we think that's a suitable arrangement. What we're concerned about is that the pushback is if we start playing around with the expenses ourselves, so you might work very hard, get more deals, bring turnover up, and then we're going to spend it all on new cars and everything. The EBITDA is now less than last year, that he's going to feel distressed by the fact that he might feel cheated in some way.
Yeah. No, that's absolutely right. What I'd say to you is this, is that there are a couple of deals that I've done recently where it seems to me that people are looking to chip the price in circumstances where I don't think it's morally right. Legally, it may be right. So, for example, in that scenario, when that deal was negotiated, if you're acting for the seller, you can build into the contract certain restrictions on things that you can and can't put through the accounts, for example. So it's quite common. In its simplest form, you can put a clause in that says that you won't do anything that is deliberately and or exclusive or partially intended to reduce the EBITDA figure, for example. So if he's got a decent lawyer, he should be making sure that that's tied off, because that's something that he should be aware to. What I would say to you is this. Depending on how long the consultancy is, so I don't know whether it's 1, 2 years.
Well, we're debating on that at the moment. He's sort of thinking about 2 to 3 years. We're thinking 1 year.
Okay.
But we're not going to push it at this
well,
stage.
I feel quite bad. I feel quite bad saying this. If it's 1 year, it's 1 year and he's done. But if it's year 1 and he thinks you've not done fairly by him, years 2 and 3 are not going to be great for you. And what will happen is he'll go off, and you won't achieve what you've wanted to achieve from him. So my view is you can have the legalities of a contract, but if you've got an ongoing relationship with the seller, which is important to the business, the aggravation that you might get by chipping him by 10, 20,000 against what you stand to lose if you don't keep that good relation to him, is probably not worth it. The other thing I say is on these smaller disputes, and when I say small disputes, really anything under 50, maybe even £100,000 is not worth getting involved in litigation over. Litigation lawyers, we're expensive enough. Litigation lawyers are really expensive, and they don't do fixed fees. They do an hourly rate. So I've got somebody coming to me saying, I think I've got a warranty claim for £6,000. Well, that's a small claim, so you win or lose, you don't get your legal costs back. You're just never going to sue on those. So my view is, unless there's something really major that happens, something expensive that's really, really going to cost you some serious money, you want to stay away from these small squabbles in these deals. And life's too short. You've bought a business. Get on and run it. And if it's a good business, then why do you want to make life more difficult by having legal wrangles potentially over fairly small sums of money with the sellers?
So just to finish on that one then, we were going to come to you as soon as we got the hots to say, is this something that is quite normal to do, and is that the sort of thing that you can structure for us pretty easily?
Yeah. So all these sorts of arrangements are mixtures of consultancy, performance-related, fixed payment. They're all really common. But as I say, if you do instruct me and I draft that contract for you, I would be fully expecting in the SPA or the APA, their lawyer to say, right, okay, for the next 2 or 3 years, the seller will have access to fairly extensive financial information, so you can make sure that he's getting what he should be getting, and that there are certain things that you will and won't do to ensure that actually the outcome at the end of that period is fair for both parties. And that would prevent you from trying to subvert the profit share and the profit figures.
So if we were looking to then maybe use some of the profits, because it's quite a profit, it's a 3.1 mil turnover with about 450,000 profit.
Yeah.
If we were looking to use some of that in the future to buy another business,
that's fine. I mean, the triggers that go into the APA for when it is or isn't fair are up for negotiation. But what you always do is you put a provision in for reasonable working capital. So if you want to keep some working capital back for future acquisitions, for expansion of the existing business, that's quite reasonable. That's why you're buying the business. And that can be made clear in the agreement. What do you want to do is stop you going out and buying 2 Ferraris, essentially, that type of thing.
Yeah, because if it's for future business, we would still have the profit figure.
Yeah.
It's just what we do with the profit figure after it's been declared through the balance sheet.
Yeah, exactly. And the way you deal with that is to make a provision for reasonable working capital requirements. Yeah.
Okay, thank you.
I have a different question to that about earnout, if I may. I'm not taking anyone else's question time away. So in this situation, it's a construction company, and it has, the assets are some plant and equipment, and it has some vehicles and some property. The property is where the business operates from. Jonathan's taught us that we can actually do interrelated company transfers of assets, so we can move the cars and the property across via a holding company to a new company, which the seller actually retains the property and the cars out of.
Yeah.
Then you dissolve that holding company. So we get that. Then the property will be leased to us. We'll have a lease arrangement so we can lease back.
Yeah.
So the next question, though, is with the plant and equipment, there's 2 parts to the question. There's also a fabrication component to the business, but he's not exploited that just yet. So the 2 questions are, should we, during the point of sale, farm off the fabrication business into another SPV and then build that up as a separate company? And the second thing is, the plant and equipment is quite a lot of money. It's about $1 million, I think, in plant and equipment. 600,000. Should we farm that off into another SPV such that that SPV then leases the equipment to the main business? And the reason I ask the question is because when we buy the second business is going to have plant and equipment, and some of the plant and equipment in the first business may be useful to the second one. So if we then pool all the plant and equipment together, and then that SPV then can farm out, lease out the various pieces of equipment to 1, 2, 3, or how many businesses we construct. Have I expressed it well enough?
Yeah. So would that essentially just leave you with the company acquiring having the contracts, operating the contracts, essentially? All of the fixed and material assets have gone out of it.
Yeah.
I mean,
so I'm asking the question, is that too complicated, or is that something that you would think about?
It's not. First of all, there might be accounting issues and tax issues arising from that. So that I don't really know too much about, and you'd need to explore that. But there might be good reasons to actually farm it all out in that way. It makes it a fairly complex company structure, so there's more accounts to be provided. But I guess one advantage of doing that, I wouldn't make, so if you were going to farm out the plant, it shouldn't be a subsidiary of the target you're acquiring. I'd put it into a separate SPV owned by your holding company. What you then do is actually you're then moving out all of the really valuable assets from the company that you're acquiring. So if actually things went wrong, the business goes, the contracts go, but the plant and equipment is in a separate company. What I don't know the answer to is what value or how an accountant will want you to deal with the fact that you've transferred out the properties and you've transferred out the plant and equipment. There'll need to be some kind of value for those accounted for, and that's not really sort of my area. It looks like you might know or might have done this.
You've got to be really careful because if you did send it into liquidation or administration, first thing the insolvency practitioner would look at is movement of goods and plant and assets. And that's an obvious thing. So if you've done it deliberately, which sounds like you would be doing, then you have to give a reason to the insolvency services why you have done that.
Yeah, I think,
so it is a risky move, but you've got to do it. Speak to your accountant, but you've got to provide. There's got to be a paper trail there, and it's got to be pretty solid. And it's just if you can put it through a few companies to get to that point, it might work out better.
Yeah. But I mean, you're absolutely right. If there's a liquidation of the company, I think a liquidator, if I remember rightly, if it's a transfer to somebody that's not connected with the business, they can go back up to 2 years. And I think if they are connected with the business, which this would be, they can go back up to 5 years to make sure it wasn't a transaction at an undervalue. So if you did do this, in order to get proper protection, as you say, there's got to be a proper paper trail first of all, and there has to be value essentially paid to the company that's getting rid of the assets. Yeah, you're absolutely right about that.
It's about growing, not liquidating.
Yeah, no, exactly.
We have no intention of going down that path.
So we always look at the doomsday scenario. So if things go well and you don't liquidate, particularly after you get past the 5-year period as well, it's fine. And I can see the business case for doing it. If you're saying, well, actually that plant can be used by 4 or 5 other group companies, then yeah, I get why you'd want to do that.